Welcome to No More, Risk Better, a CreditSights podcast. Across the global strategy team, we aim to make sense of the macro and the micro, highlighting opportunities and the risks facing the fixed income markets.
As the macro makes headlines, we leverage our network of experts across Fitch Solutions to better understand economic trends, rates gyrations, geopolitical events, and how these factors impact corporates.
At CreditSights, we understand that credit investing comes down to picking winners to generate alpha and avoiding losers. Our team of over 100 analysts across the US, Europe, and Asia provide unmatched sector expertise and fundamental knowledge.
In our weekly podcast, the strategy team offers a look at the conversations we have with our colleagues, including analysts, fellow strategists, economists, and leveraged finance market experts. If you want to know more so that you can risk better, you'll want to give this podcast a listen. Hello, everyone. Welcome back to the CreditSights No More, Risk Better podcast. This is Winnie Cisar, Global Head of Strategy at CreditSights. And today we are talking all things macroeconomics with two of my favorite economists. First, we have Brian Coulton. He is the Chief Economist of Fitch Ratings, and Cedric Chehab, Chief Economist of BMI, which is a Fitch Solutions company, one of the sister companies to CreditSights. Brian, Cedric, thank you guys so much for joining me today to try to figure out what on earth is going on in the world of macro.
Thank you.
Good to be here, Winnie.
All right. So I think that it's always important as strategists, as economists, to do some reflection, to think about the lessons that we have learned. And I would love to do a little speed round introduction and think about what is the lesson that you have learned in 2025 that really stands out to you. And then how are you applying that lesson to forecasting into 2026? Brian, let's start with you.
Yeah, sure. Thanks, William. Yeah, I mean, this year has really all been about policy shocks and policy uncertainty, right? With this stratospheric increase in the US tariff rate. And one thing that's been really interesting to watch as that has happened, as that environment has emerged, has been the reaction of the private sector, the way that households and firms have responded to that in trying to mitigate the impact on their business and their household income and their household consumption. There's three specific ways I think that has kind of had a really important impact on the way this has affected the economy. First of all, we had this forestalling of or front running of exports to the US ahead of the tariff increases. That has made a really big difference to some of the quarterly path of US GDP. We've also seen in Mexico and Canada, trading companies there have really, really quickly adjusted the classification of their goods to make more of them in line with USMCA. And that's had a huge impact on the effective increase in the tariff rate. And then I think one that's been really interesting and maybe has been a factor explaining some of the surprises sort of at the relatively slow speed of pass through from the tariff shocks to CPI has been, I think there's quite a lot of evidence that because the uncertainty was so huge in the second quarter, firms didn't want to necessarily make big changes to their pricing without knowing that these tariff increases were there to stay. And for us, that's a pretty important factor going forward. Is that now going to change? We can come back to that. But I think thinking about that private sector, obviously the first thing was like, here's a policy shock. Crikey, this is huge. We've got to think about how it affects the economy, but how the private sector has responded to trying to kind of work its way around it and trying to minimize the impact. That's been really fascinating. I think some important lessons there for next year.
Yeah, I think that is a great point around just the private sector having a lot more levers to pull than I think many people anticipated. Cedric, how about you? What is your top lesson learned in 2025, and how are you thinking about that lesson going into next year?
So funnily enough, I'm taking the other side of the coin that Brian just took. So I would say the public sector, in the sense that we had pretty big fiscal and monetary stimulus over the course of this year. And that really helped to also act as a shock absorber. And slightly different to maybe the private sector is that my question for 2024 is there an overhang or a carry through from this fiscal and monetary policy? So China was already enacting fiscal policy late last year. We saw Germany come out kind of earlier this year and announce some pretty big packages. The US big beautiful bill, of course. And then you had most economies easing monetary policy this year, right? And that the impact of both fiscal and monetary policy should be felt in 2026. So I think that was a bit surprising, and that's helping me to think about next year.
Yeah, I think that is a really good one. And I think that taking together both of your remarks really kind of go into my lesson learned in 2025. And that all is thinking about timing, because I think that a lot of people, around Liberation Day expected there to be a really immediate, concrete pass through into earnings, into inflation. And I think that thinking about the sequencing of timing and how a lot of the policy change is going to work through both economics and the market more broadly, you have to be a little bit more nuanced in your thinking, rather than just, announcement today, fallout tomorrow, because that has certainly not been the case this year. So, Brian, last week you spent at the IMF meeting in Washington, D.C. I'm sure there was a lot of chatter around the outlook for the U.S. and the global economy. I would love to hear what the general tone of the meeting was. Were people constructive? Were people cautious? Was it a mix of both? Generally confused, which is kind of how I feel lately.
Yeah, there's no shortage of confusion and feeling chaos, but I think I would summarize the kind of broader takeaways for me. First is definitely a sense of relief that the tariff shock hasn't proven to be as damaging so far to the world economy as many expected. Remember, the IMF's previous forecasts were finished in April. They only do these 6-monthly updates. So, that was kind of, right after Liberation Day. So, but definitely a sense of, or maybe things are not as bad as we thought. Definite feeling of excitement about AI, about both the near-term impact that's having through all the Capex that's related to AI, boosting investment and boosting demand that way, but also the kind of medium-term benefits that we might see on productivity. One thing that struck me a bit surprised actually was the amount of hope there is and the amount of discussion about the deregulation agenda. A real feeling that this is something that governments are constrained on the fiscal side. Inflation is not that low. It's not so easy to get a big kind of monetary boost to the economy. Whereas deregulation, I heard somebody describe it. Well, this is kind of a free way to get better growth, right? It doesn't cost you anything. Quite a lot of store being put in that. Not just in the US. After the Draghi report last year, a sense that Europe understands this now. Describe that as hope, because I'm not sure I'm seeing very much concrete evidence so far. But Rachel Reeves talking a lot more about that in terms of getting UK growth back on track. And then of course, being an economist, fear. What have been worried about? Well, bubbles, particularly in equity markets. That's definitely a strong theme. Concerns about the slowdown in US job creation. And then thirdly, these big fiscal deficits we're seeing in the US, UK, France, worries that, is that going to spill over into the bond market, pushing up interest rates at a time when growth is challenged? I think those are the key takeaways for me.
Those are great takeaways, and honestly, a little bit different than what I would have expected. Maybe there's some tension around that excitement around AI being, a Capex boosting investment, but also perhaps contributing to some of the worries around bubbles in the equity markets. I would love to follow up on that sense of relief around tariffs not being as damaging so far. Recently, we've seen a step up in tariff related headlines, especially in the US China relationship. And it seems like the tariff reality so far from that economic or earnings perspective has been pretty minimal, although, kind of spotty. There's definitely been some sectors that have been under a little bit more pressure. Do you think that it is too soon to kind of signal the all clear on tariff fallout? Is there something that we should be looking for? as, tariff fallout still to come? Is it the US jobs market? And then how are you thinking about kind of the timing and the direction of the impact? Is this a growth headwind? Tariffs are a tax, or is this an inflationary pressure as companies are forced to push through higher pricing to preserve margins?
Yeah, I think it comes back to the point that you were just making, Winnie, about how these private sector responses have changed the timing, and made this kind of impact a little bit more sort of delayed, I think. So, we live in a world of instantaneous news and instantaneous market reaction to that news. And it's very easy to kind of get into this mindset of the economy's got to, respond immediately, as you said, and it doesn't kind of work out that way. But our view in Fitch Ratings is that we are going to see more pass through to the CPI going forward. We're also already seeing evidence. If you look at the goods component, core goods component of the US CPI, it's up to 1.25% now. Long run, that's about zero, that number, right? So goods prices generally haven't moved 20, 30 years, excluding the pandemic period. So we're back into positive territory there. The items that are more affected by tariffs are starting to move upwards. We expect to see more of that because firms, while we didn't know in Q2 where the US tariff rate was going to end up, leaving this current kind of spat between the US and China to one side, let's assume that we don't get that 100%. We're pretty close to knowing where we're going to be. We're going to be about 16 to 17% on the US effective tariff rate. And I think most US firms know that now. And so, this isn't going to be something that if they raise prices now in response to that, they're going to get caught out in second, towards the end of the year as Trump reverses course and we go back down to a 5% tariff rate or something. No, that's very, very unlikely to happen. So I think there is going to be more pass through. So we've got US inflation heading up to 3.5% by the end of the year, as we get more pass through.
All right. So a reacceleration in inflation due to tariffs. I don't know that I can necessarily disagree with that view. I think that we've been a little bit more concerned around the labor market. And I think that there is also another tension between, the big corporations who perhaps have more pricing power, who can push through pricing, whereas, small and medium-sized enterprises, which make up a large part of the US economy. And I think that that is a little bit of a trickier situation from a tariff perspective, from a price taker versus a price maker perspective. So that's something that we've been really focused on the CreditSights side. So Cedric, you are always my favorite bull to talk to. You've been, I would say, more constructive in general on especially the ability to withstand some of the tariff fallout, probably because of stimulative fiscal and monetary policy. How are you thinking about the kind of current situation within industrial policy? Do you think that some of the recent tariff policy headlines or changes have been an escalation? How are you thinking about the path of tariffs?
Yeah, first of all, thanks for calling me your favorite bull. I think I'm just a little bit less pessimistic than others. But to Brian's point, right, there are a lot of risks. So we also think that as inventory is rebuilt at higher prices, then you have a bit higher inflation, and that could give indigestion to markets over the next 2-3 months, particularly where the labor market and the housing market is in the US. So those are things I'm thinking about. But in terms of your question around industrial policy, I was surprised, but at the same time, I kind of wasn't. And I wasn't because back in, was it 2021? I think we published a special report. It was pretty comprehensive, and it basically looked at which industries did we think China was going to basically reach the same level of cost competitive or value for money at the same, where they would start to take market share. And it was clear that Western incumbent companies would have to become much more protectionist. Now, what took me by surprise was how fast it escalated in terms of tariffs, in terms of the export restrictions, and now how the threats have come from the other side in terms of rare earths from China. So that's really been a big kind of a spanner in the works from a global trade perspective. But for the US, I think the way to think about it is Republican lawmakers feel as if their economic and military supply chain has been compromised. Like, I think that's what Republican lawmakers feel like. And China is a rising economic, military, and technological competitor. And this is very different to Japan in the 80s, which was just kind of an economic competitor. And so this is very different. Second of all, I would say the protectionism and industrial policy is very much tied at the hip, in the sense that although tariffs are a blunt tool, they're being used to attract investment, they're being used to kind of boost manufacturing, and this helps create jobs, strengthen supply chains, raise tax revenue even, perhaps. And then the third thing is the government is actually taking active equity stakes in companies and industries which are very similar to those that they're highlighting in Section 232s and 301s. And this is really different from what we've seen before. So we've seen industrial policy in the East, right, as economies develop, but we haven't seen this in the West, so to speak. And so those investments in terms of MP Materials, Intel, and other companies, and we think more and more is we're gonna see more of that. And that's really because the US government really wants to de-risk from China and is making equity investments in order to really move as fast as they can to do that.
Yeah, it's been really interesting. We did actually a report looking at some of that government intervention into private industry, and it's been very much a mixed bag in terms of the kind of market reaction to some of that. But some of it has been, very positive overall.
Mhm.
Another thing that we have on our upcoming 2025 bingo card is, of course, the Supreme Court's hearing around the IEPA tariffs, which is scheduled for the first week of November. Cedric, are you worried about potential market or economic fallout from that case? What if the Supreme Court says, we're sorry, Mr. President, but this was not permitted and these tariffs are unconstitutional? That seems like it could set up some pretty significant chaos.
Yeah, I think that's right. So what's interesting is that I think it's hard to have a strong view on this, and we have a house view, but we don't have a very high level of conviction. But we think that there's going to be somewhat of a compromise, and that's what we'll get to. So we think that the Supreme Court will probably take its time to hear and deliberate kind of the arguments. They'll also probably take a legalistic approach to this, and instead of saying basically, these tariffs cannot go ahead, I think they probably might turn around and say, look, you have to look to formalize the emergency tariff, the IEPA tariffs, because, an emergency can't always be an indefinite emergency. So how do you formalize them using, Congress or something? And I think this would be a compromise. It provides him kind of the executive bandwidth to kind of enact key foreign policy, which he's allowed to do. But at the same time, it also restricts his ability to act so unilaterally, and it brings kind of this policy back into the formal fold or legal fold, so to speak. So that's where we are now. But to your point, if, for example, they say they strike it down and then he tries to pursue it in other ways and it causes more uncertainty. Because to Brian's point earlier, it's like companies, what was hurting them was they had no idea where this was going. Now they know roughly where it is, they can plan. But if they don't know where it's going, they can't plan. And that's the real problem.
Yeah, not being able to plan is such a significant problem. And it's so interesting too, because we sometimes talk about these tariffs policies as if they are going to be in place in perpetuity, but we know that political administrations turn over quite frequently in the US. At least they have historically. We'll see. We'll see if that's the way of the future.
Well,
Um,
Winnie, I'll just
yeah,
jump in there. I think it'll be, if let's say Democrats win the next election, I think it's going to be very hard for them to reduce the tariffs, because they're already bringing in quite a lot of revenue, about $30 billion a month. That could rise to a bit more. Maybe that's something like 360 to 400 billion a year. That's not
yeah.
change.
Yeah, it's true. But I mean, and from a kind of democratic perspective, it's kind of like a sneaky backdoor corporate tax, theoretically, right? Like it's
Consumer
a way
tax,
of
back
raising,
corporate tax.
yeah,
Yeah.
yeah, raising the tax rate without actually raising the tax rate. And so that is not necessarily at odds with the democratic agenda. It's, of course, how are those proceeds used, and where do they go once they're in the US coffers? Um, a lot to unpack there, of course. Let's move on from tariffs, although perhaps this is a somewhat related topic. Brian, on the credit site strategy side of things, we've become much more worried about the US labor market. Of course, we didn't have the most recent payrolls report because of the US government shutdown, but before that, we've seen a pretty significant deceleration in the pace of job ads. to levels that are more consistent with going negative next rather than rebounding nicely. Were labor market worries a major theme at the IMF meeting? And then how are you thinking about the outlook for the US labor market over the next 12 months? Are we poised to recover, or is this going to be kind of a tough slog?
Yeah, no, it definitely was. I was on a panel on the US economy at the Institute of International Finance, and uh, you know, the labour market numbers were a big focus. Some pretty bearish views out there on where the labour market's going, and understandable given the numbers, right? 30,000 a month on average the previous 3 months. Although, as you say, we're kind of a month late on the data, so we don't have any visibility on September really at all at this stage. Um, it's quite possible that again that's been how firms have reacted. I said, well, we're not going to put prices up, but we're not going to do as much hiring as we might have otherwise done as well. Some of the detailed numbers you see from how corporates have responded to the increase in taxes. They pushed down unit profits negative year on year in the national accounts on the corporate sector, value added inflated, but also unit labour costs slowed as well. So they're squeezing more out of each worker. So it's possible that it's had an impact there. But I think the other thing I would flag here is the slowdown in labour supply, which has also been influencing the numbers. This squeeze on immigration, which started before Trump. I mean, this is the second half of 24. We started to see those border apprehension numbers slow down sharply, and now we've got the deportation as well. Um, when we recently published an update to our US potential growth estimates, so the kind of next 5-year outlook, and we're now assuming immigration falls from 2.25 million over the last couple of years each year to about 500,000. It's a really sharp slowdown. So we're looking at growth in the labour supply having been just shy of 1% per year. It's going to fall to about half a percent. And now, if you work that through the numbers and you say what's the monthly rate of payroll growth consistent with a slower growth in labour supply without pushing up the unemployment rate, your kind of equilibrium monthly payrolls is sort of sub it's around 70,000 instead of 120. So given that shift in labour supply, we shouldn't be expecting job creation to be so strong. I think the average was 30,000 over the last 3 months. I think we had a pretty decent print, 70,000 in July. So, it's you can't say it's all down to slower slower labour demand. And of course, with labour supply slowing, we're not seeing an increase in unemployment rate. It's still 4.3% is still kind of 20, 30 year low. We're not the evidence we've got for September. I know we've got some private sector measures, but they don't have a great track record. Unemployment insurance claims at state level are on rising. You look at the breakdown of job growth before, up to August. It's true that a lot of sectors showing negative growth: construction, government, manufacturing sector, but education and health, that's 20% of the total. That's still growing strongly. Leisure and transport still growing. So, I, I, I'm not as bearish as some on the US labour market, and we need to get used to a slower pace of job creation than we've had in the past because of this squeeze on immigration.
All right, so getting used to a slower pace of job creation, and that's actually something that I think it was the Dallas Fed. They put together a blog post looking at what is the new kind of equilibrium from a job ads perspective given changes to immigration policy, and it is to your point, Brian, materially lower. But it seems to me all of these different policies, all of these different factors, it leaves the Fed first in very uncharted territory and also in a little bit more of a precarious position than maybe the market anticipates. Right now the market is anticipating a pretty gradual easing cycle, 2 more rate cuts priced in for this year, a terminal rate around 3%. That seems like a not too terrible outcome overall. But of course, we're managing to, what is the tariff inflation versus just inflation that the Fed can't look through? Do we see job ads go negative? If AI and Capex is driving an investment boom, like why isn't construction and building materials faring better from a labor market perspective? So I guess the question here is, Brian, do you think that the Fed is in a little bit of a trickier situation? Do you think that they have a higher probability of making a policy error? How are you thinking about the path for the Fed?
Yeah, very good question. I think they're in a bit of a pickle. I mean, the Fed likes to be, we're kind of proactive. We see these risks, we take action to mitigate those risks, and that's sort of how they like to be viewed. But it's really difficult for them to act that way at the moment. Act kind of really decisively and aggressively. I think they're in a bit of a bind because they're too the dual mandate. They're moving in contradictory directions, right? You've got unemployment, labor market weakening, unemployment potentially rising, although not much so far. But we're already in a situation today where inflation is still quite a fair way above the target. I mean, the last 3 month on 3 month core inflation is back up to 3%. And both the Fed and our own forecast even more so, we've got inflation going up. So they're going to be getting further away on from the inflation mandate. So what they have told us they will do when they're in the situation of this contradiction between the two targets is, whichever indicator is furthest away from the target, that should have a bit more weight. Well, if our expectations on CPI inflation are correct, that's where the biggest gap is gonna be going forward. And yet they've just cut rates because, partly because they said the risks of the unemployment mandate again. So it's quite a tricky position for them to be in. And I think the outcome is that actually they'll continue to cut, but it will be quite cautious and may not be as aggressive as some of the market expectation, just because, we want to cut rates, but we want to keep rates restrictive because then we're kind of, we are doing our job responsibly. We're keeping monetary policy tight because inflation's high, but we're easing a bit to reduce the risks of unemployment. But if they start slashing rates 50 basis points a meeting, you get 150 within 6 months. They can no longer kind of nuance it that way. But all of the recent statements have been quite nuanced, and I only did 25 at the last meeting.
Is it nuance? Is it confusion? I think that's the new question for the Fed. And, not only just, rate cutting or rate hiking policy action, we also are looking forward to perhaps the end of quantitative tightening at the end of this year. And so that's another factor that the Fed will probably need to be keeping in mind as it thinks about market bubbles and, policy being accommodative versus restrictive. I think, Brian, your point around expectations of a proactive Fed, that comes up very frequently in my discussions with clients. People feel really comfortable that the Fed is going to be kind of ahead of the curve in terms of easing policy. And that makes me a little bit nervous as, someone who's seen a number of cycles where the Fed has to be reactive. And that's where you see credit spreads gap out quite significantly, a lot of equity market volatility. Cedric, I'd be curious to hear from you. Does that kind of disconnect between markets, which have been almost unstoppable, but for a handful of jitters around China-US trade and perhaps some of the recent credit concerns at some regional banks, and then the laundry list of macro worries that we have. Do you think that there is a disconnect there? Does that worry you or surprise you, or do you feel like actually markets are pricing in things a little bit more appropriately?
So I think there's a disconnect, and I'm both worried and surprised. I don't know if that's the answer you wanted to hear, but I mean, macro and market disconnects typically do happen at turning points, right? So for example, the market starts to price things in, like let's say at a bottom, they start to rally, the fundamentals still don't look that good, and so the market leads the macro. And the way I'm thinking about it is either the markets are right and the macro is going to catch up, or the market's wrong and the macro's right and then the markets are going to catch down. And there's no real way of knowing just yet. But I think, if I think about the economy as this kind of engine which has momentum, and a lot's been thrown at it, but a lot of interesting things have come out as well. So we've seen kind of earnings remain quite strong. We've seen economic momentum remain strong. Certain parts of the economy don't look great, as Brian and you just discussed, but certain parts are okay. If you add in deregulation, lower interest rates now with the Fed cutting, and kind of 10-year yields, 2-year yields dropping quite substantially. And also we've had a little bit of tariff walkback potential in the past few days. maybe there's enough to be optimistic about from a fundamental perspective that justifies the economy growing into the more bullish market environment. But at the same time, and I'm going to use my two-sided economist's hands here, the rally has been much sharper, and there are lots of headwinds that are really top of mind, which I think are kind of black or white, no real gray area. So, for example, Brian mentioned the labor market. He's not as bearish, right? And I think I agree with Brian, as in there are lots of reasons to think why hiring stopped. Why would you hire if you're a business? If you have uncertainty, you have to protect your margins because you're going to get hit with tariffs, and you're investing in AI labor and in AI, which is labor-saving technology. Like, you wouldn't go hire. But the point is, the labor market does crack. Like, that's the worst thing you can crack. And so it's a little bit binary there. Then the other thing is, another escalation from China, between China and the US. You get a misstep here, and you could get maybe a hit for like a few weeks, and then businesses at that point, they just say, you know what, we've had too much uncertainty, and we're just we're kind of throwing the towel in a little bit. So in that sense, I'm kind of confused, as you said at the beginning of the podcast. And I'm kind of hoping that it all works out well, that the macro catches up to the markets. Now, it never happens in a pure linear fashion. Usually there's a bit of volatility, a few scares. But one thing which I really can't get my head around is, I feel as if there's so much disagreement about what the economy is doing and where it's going. And I feel as if there's a level of disagreement between investors, your kind of talking heads, ourselves, for example, and policymakers as well, that there's just no agreement. And I feel as if like that disagreement or lack of agreement has been going on for a long time, first of all. And second of all, it maybe just reflects that since 2020, the global economy has been in multiple cycles at the same time, and just so hard to decipher.
Yeah, it has been really hard to have kind of a clear economic thesis about the global economy, the direction of it. Something that I find interesting, we have a couple of fair value models for US credit spreads, looking at macro and market indicators in a regression to kind of predict where cash spreads should theoretically be given those conditions. And for both investment grade and high yield, our fair value spread level is materially tight to where cash spreads actually are. So as much as credit investors are looking at, 80 basis points in IG, 300 basis points for high yield and thinking, wow, this is just so tight, those macro and market indicators would actually imply tighter spreads than where we are currently. Now, of course, this is just a regression model. It's not a forecasting model. So if some of those macro and market indicators change or erode, then spreads can gap out quite significantly. But I think it's really interesting to see just that kind of disconnect between the perception of things being really tight and the reality of like, oh, they should actually maybe be tighter given where we've been in broader economics. All right. So, Brian, you mentioned earlier AI as a very topical theme at the IMF meeting. Every client I talk to is definitely understanding or trying to understand how AI is fitting into both the US and then the global economic cycle. How does the IMF think about AI Capex as a driver of growth? Is that a long-term sustainable trend? Is it more short-term or medium-term? And then, Brian, what do you think of AI spending and deal announcements that we've seen this year? It seems a little bit like a circular reference type of spending environment right now.
Yeah, the numbers are just huge, and they're really affecting the kind of macro picture, and it feeds into this kind of bifurcation that that Cedric was talking about. It's one of the reasons we've still got decent, okay growth in the US, even though some of the other indicators have weakened. Just done a calculation, so between Q4 2024 and Q2 2025. The US economy grew 0.8%. So that's not an annualized figure. That's the way we do it in Europe. That 0.8%, 0.7 percentage points down to IT, software, and hardware. So you can say 90, 85, 90% of the current growth we're getting. So, that in itself tells you how important this how important this is. Is it a bubble? I'm no expert on the technology or the sector. I'm not an equity analyst. All I'm saying, it does feel like there's some pretty real changes going on. This feels like something that could be quite transformative to the world economy and society. Compared to say the crypto bubble a few years ago. What's that going to do to the world economy long term? Really wasn't sure at all. But this does feel very different. One interesting feature of we've got this boom going on in Capex, a lot of spending, a lot of strength in the financial markets in that sector, but we don't seem to be in the middle of a broader corporate sector credit boom in the US. If you look at growth in credit, include throw everything in there, the non-bank lending as well as the bank lending, it's kind of growing in line with GDP. It feels like that's more kind of equity investment going into these sectors, which from a macro vulnerability perspective is a little bit less worrying than if it was US non-financial corporates, surging, borrowing, increasing their debt very rapidly. So big changes in how that relatively steady corporate debt to GDP ratio, how it's funded. So the share of private credit's gone up a lot. Maybe there's some issues there, but we're not in the middle of a broader US corporate credit boom, as far as I can tell. As long as it's assuming that the US flow of funds measures all this stuff, which it does purport to do, but doesn't seem to be very difficult to find a measure of equity market valuation. They all seem to be pointing to the same conclusion, that the equity market looks toppish, whether cyclically adjust PE ratios, I look at the inverse of the PE ratio, think about that as a kind of real rate of return for the marginal investor equity. That's 4% now. If you compare that with the risk-free rate, you can get 2% real on the 10-year treasury. So that yield premium on equities is pretty low at 2%. So to some extent, I think that's the bigger near-term macro risk for me. If we were to get an equity market correction, then that feeds back to our high consumer saving ratio through the wealth effect on the consumer side. The AI cap, I know if you're in the middle of building a data center, you're not going to stop just because somebody, in the risk department says, actually, we're not quite sure anymore. So I think that's got legs. I think we're going to have strong capex in this sector for a couple of years. I'm not so worried about that suddenly grinding to a halt. So although, it's explaining a lot of the growth, I don't think it's suddenly going to evaporate that capex spending. It seems pretty real to me, this data center thing.
Yeah, the CapEx spending is incredibly real. The return on that CapEx spending, I think, has been more of an open question mark. And, looking at earnings expectations for 2026 for the Mag 7, especially who tend to be kind of front runners in the AI investment, earnings growth is expected to be in the 15 to 20% range in 2026 for the Mag 7, which would be a significant step up from 2025. And then we've also seen, a tremendous amount of growth in single name leveraged equity ETFs for a lot of these companies. And so as I'm thinking about the wealth effect and something that could potentially be a challenge, if we have, some sort of, cycle that challenges some of the Mag 7 earnings expectations and return on investment assumptions, and some of these single name leverage ETFs start to come under pressure, and then we see extended pressure in equities more broadly, that puts a pretty big damper on the wealth effect very, very quickly. And so that's just something that we're kind of monitoring from our end, because as you noted, from a credit perspective, we're a little bit more sanguine on kind of the AI investment risks. Although, of course, corporate credit spreads are not going to emerge from equity volatility totally unscathed if there is an AI bubble that ultimately kind of pops. Cedric, on the AI investment cycle, do you think it's going to again provide this really outsized supports to markets in 2026? Are you a believer in that 15 to 20% earnings growth for the Mag 7?
So I'm not sure about the markets and their earnings growth, but I do certainly think that it will provide support to the economy. So just if you look at the 4 largest hyperscalers, they increased their annual capex this year. They will have by about 130 billion. And then next year is going to be another 64 billion or so. So that's a lot of money. And if you look at data center investment, the construction element of it. So I think we only have data back to 2014, but in 2022 it was something like accounted for the equivalent of 0.6% of GDP, and now it's about 1.6% of GDP. So that's 1 percentage point increase. And as as you were saying, you're not going to stop midway through a data center. You're going to complete it. And our technology team is tracking a huge pipeline of planned and under construction data centers in the US and around the world. So that has legs. But I think when you asked about markets and sustainability, what's interesting, I was looking at kind of 1998 just for fun. And there are a few interesting things there, right, with the comparison. So the first one is, as a share of GDP, technology investment has risen, but it's not as high as what we saw in the kind of mid to late 90s. Okay. Companies now are much more profitable. So if you look at the NASDAQ, has something like a 14% profit margin, about 11% EPS growth, maybe a bit this year, higher, as you said, maybe next year. If you look at IPO activity, it hasn't gone bananas, right? In the late 90s, it went bananas. It's still quite kind of tepid. So that's quite interesting. So I don't feel as if people are over their skis just yet. And it's funny, people are calling this the everything rally, which maybe because you have a lot of different asset classes. But if you look at market breadth, it's not that broad. If you pop the hood for the NASDAQ or the S&P 500, I think the number of kind of stocks, or the percentage of stocks trading above their 200-day moving average, something like 50, 60, depending on which one you look at. But that was closer to 70, 80 in the 90s. And the reason why I'm looking kind of like 98 is because in 98 you had a 30% correction, which similar to the 30% correction we had this year, right? So if you put them together and rebase them to this just before the correction, it basically NASDAQ fell something like 50%. Fell 30%. And if you align it to this year, then what we would have seen is the NASDAQ already rallied about 50% from the low, right? But for it to recreate the bubble that we saw in the late 1990s, it would require another 140% rally from here, and that to about kind of mid to late 2026. So for that reason, when I think about bubble, I'm not so sure. I mean, it definitely feels like there are elements of that, but I think the macro fundamentals are probably a little bit better. But these things can move very quickly.
They certainly can move very quickly. I think that the AI conversations, just how they've picked up this year, has been really, really mind-blowing. And the thing that I struggle with on AI is, so either all of this investment, there is going to be a tremendous return on investment. We're going to see amazing productivity gains, but that seems to have some pretty dire, or at least challenging, implications for the labor market over a medium-term basis. Or all of this investment is just going to be kind of like a nothing burger or take longer than people are expecting, which also seems not great. So I'm trying to figure out like what the true near-term bull case from an AI return on investment and also the labor market is unscathed perspective is. And that's a hard thing to identify.
So Winnie, you're going to laugh at me, but I just remember to have a book on my table, which is basically called Pop, Why Bubbles
Oh,
Are Good for the Economy. So this is a
perfect.
book I bought many years ago, and it talks about kind of the telegraph, the railroads. And it's interesting over a long-term perspective, the argument goes that you build so much excess capacity that you can only do in a bubble because you really kind of galvanize all that investment. And
Mhm.
what happens is once the bubble is over and the economy is stable, you're able to grow into your next phase of the economy in a non-inflationary manner because you've built out
Yeah.
that infrastructure. So your ability to create a really strong domestic market across the world, across the U.S. for kind of goods mostly after the railway boom was because the railway was in place. So I mean
Mhm.
that's one hypothesis, but I thought it was
Yeah.
interesting, and I like history.
No, it's totally true, and it's the same of the late 90s and, all of the telecom companies putting together the infrastructure for, the World Wide Web and the digital highway that is the internet. But you did have that kind of dot-com bust that then it was like, okay, well, now we have a lot of fiber. what are we supposed to do with all the infrastructure here? So I think that your point around, there is creative destruction within capitalism, and you need to have some sectors and some segments of the economy eventually reach obsolescence. And sometimes it takes longer to get to that return on investment, and everything, turns out better in the long run. But there could be some real pain in the
Yeah,
intermediate term.
yeah.
So, Brian, we've talked a lot about the US, but I'm assuming that, the IMF, given that it is international in nature, probably talked a lot about some of the other regions where our views are really evolving. I would say that in general, analysts are maybe a little bit more cautious on the outlook, or more constructive on the outlook for the Eurozone. Seems like Chinese domestic growth could be more vulnerable despite exports remaining generally on track, although they just printed GDP that I think was in line with or better than expectations. Let's start with Europe. How impactful do you think German fiscal easing will be to the broader Eurozone growth outlook?
Yeah, I think we do think this is a pretty important change, and is going to lead to a pickup in Eurozone growth next year. Now, nothing dramatic. I think we're talking about just over 1% from something zero in Germany this year, and only slightly above 0.5% for the Eurozone as a whole. So, but I do think it's moving in the right direction. You got to remember, this is a German government that for years and years and years just really didn't want to use fiscal space to support the economy. And that has changed. And although maybe it's taken a bit of time to get things off the ground and stuff, kind of the nature of what they're doing, infrastructure and defence, you got to suddenly write a check and start building this stuff immediately. But we do think that this will make a material difference. Sorts of fiscal deficits projections we're looking at for Germany. You've got to go back to the 90s to see a period when they're clearly loosening fiscal policy as much as this, and I think that will make that will make a difference. Even if the multiplier is a little bit on the low side, because some of the defence spending is going to be spent on imports. That's still going to spill over to the rest of Europe, right? Italy, France, are going to benefit from that as well. It's also the last year of the Next Generation EU funds, so there'll be pressure to spend that. And then don't forget the monetary easing that the ECB is doing. That is translating into stronger credit growth. It's seen quite a marked pickup in credit to the private sector. So, look, starting from a very weak base, we're still going to be looking at a number that's weaker than the US, probably in 2026. But better than it has been, I think, partly because of that German fiscal expansion.
Better than it has been. Always a good outlook for sure. So, Cedric, you are based in Singapore, so you are our expert based closest to China on this podcast recording. How are you thinking about the outlook for the Chinese economy? I would say that consensus forecasts are pointing to a bit of a downshift in growth. Do you think that this is a reality? Does it even matter?
Uh, I think it's definitely a reality. So, I mean, growth came in, as you mentioned, 4.8%. It was a little bit above consensus expectations. But given the first 2 quarters of the year, basically it's going to come in line around 5.1%, depending on the final quarter. And that's in line with the government's kind of around 5% target. So are we surprised that it's around that level? No, it's the government's target. And according to one famous politician, all statistics are man-made. So I'll let you interpret that as you will. But when I think about the Chinese economy, is like lots of people have been talking about a K-shaped recovery or K-shaped economy in the US. I kind of feel like there's a K-shape in China, right? So you have this strong growth of exports because a lot of that's been front loaded, but other parts of the economy are just not doing well at all. So, and those exports which were front loaded have to, if you have high inventory around the world, that it's going to slow going forward. So we know the consumer story remains weak. They had this kind of trade-in program for durable goods. Like there are only so many washing machines the household can buy, right? You run out of space. And so that's starting to weaken. Then you have fixed asset investments quite weak. We have a lot of overcapacity in the economy, and we're starting to see kind of fixed asset investment, I think, decline for the first time in several years now, just in September, just marginally. And then, of course, you have the housing market, which remains quite weak as well. So it's not as if, it's like 5% bad quality growth, maybe, where there's a kind of K-shape. And we forecast a slowdown to about 4.1% next year. So quite a
Wow.
meaningful slowdown. I think the IMF has it at 4.2% next year as well. So I think there's broad consensus that the stimulus and the exports that helped this year are going to give way to kind of weaker exports, less stimulus next year, because they really went all out. And then you have an underlying weak consumer story. So I think that's the drag. But Brian's also quite an expert on China. So I'd be keen
Yeah,
to hear
Brian,
what Brian thinks.
yeah, I'd love to hear. Do you have any follow-up thoughts on China, either your personal take or what you heard at the IMF meeting?
Yeah, no, I agree very much with Cedric in terms of the vulnerabilities in the domestic private economy, and just flag, these fixed asset investment numbers, it turned negative. That's a year-to-date, year-on-year number. You
Yeah.
can look at the numbers in a slightly more high-frequency way, which is September versus September last year. And we're down -7. I've never seen anything like this outside of the COVID shock. And look at nominal GDP growth, not real, nominal, right? China's been in
Yeah.
deflation for 10 quarters. Nominal GDP growth in Q3 was 3.7%. In the US in Q2, nominal GDP growth was 4.5. So the Chinese economy in nominal terms is growing more slowly already than the US economy. So big concerned about once you start to dig underneath that headline number, China does look vulnerable on the macro front.
Yeah, it'd be interesting to see because they have the 5-year plan, right? Beijing's meeting, so it's going to be interesting to see what they say. I mean, I assume they're going to say things like sustainable growth, economic rebalancing, moving up the value chain, growing trade, and whatnot. But I think it'll be interesting.
Always interesting for sure. So we have managed to, I think, cover a lot in the world of global economics over the past 50 minutes or so. I'd love to do a quick speed round to wrap this up. And I always love to hear contrarian views. And so, Cedric, I'm going to start with you. What is your most contrarian take for 2026? What's going to be something that surprises everyone?
So I don't have a high conviction, but U.S. economy runs hot and the dollar strengthens
Ooh,
because
that's
everybody's
fun.
bearish the dollar. So I think that might be a fun one.
That's a really fun one. Brian, what do you think? What's your most contrarian take?
Yeah, I don't think Cedric is crazy about this at all because there's quite a bit of fiscal easing in the US. But I would say, and so we'll come back to your last question, contrarian. I think a couple of meetings ago, I think I was the only person out there to kind of express these concerns about China's growth numbers. I mean, these fixed asset investment numbers really, I do worry a bit that the macro policy response to, they've kind of woken up to the fact that they're in deflation and they've got this anti-involution campaign. But I do worry maybe that's a bit of a policy misstep because yes, that will reduce capacity in the long run, but in the near term, it's going to reduce demand if the response to that policy is that local governments to say, oh, we shouldn't be doing more capex, slowing down the infrastructure investment. The infrastructure numbers are really weak. So, that's really one to watch next year. I think the macro risks in China. I think we'll be talking about that a lot more.
Yeah, I think it's been surprising how little people have been talking about the macro risk in China. If you look back to the market action in 2018 around trade wars 1.0, there was a lot of market volatility that was predicated on, oh no, what is going on with the Chinese economy? Is that going to be problematic for the global economy? And so I think that that's a really good point, something to definitely keep an eye out on. I don't know that this is a contrarian take, but I would say that my contrarian take for 2026 is that fundamentals are going to matter again to investors. This year in the credit markets, it's been all about technicals. It's been all about the flows. And people have basically said, the fundamental just doesn't matter as much. I have to kind of close my eyes and put cash to work. And sometimes those technicals change very, very quickly, and the fundamentals will come to the forefront again. So, or maybe I'm talking my own book as a credit strategist. Probably so. All right, Cedric, Brian, thank you guys so much for joining me today. This was a really great discussion. I always learn a lot talking about true economists versus just me as a credit strategist trying to make it up as I go along. If you enjoyed this conversation and have questions for me, Brian, or Cedric, you can always reach out to your Fitch or Fitch Solutions salesperson. Like, share, subscribe this podcast. We appreciate you listening in, and we will be back with some more really great podcasts through the end of the year. Thank you, guys.
Thanks, Winnie.
Thanks.
Cedric.
CreditSights disclaimer. All price references correspond to the date of this recording. This podcast should not be copied, distributed, or reproduced in whole or in part. Neither CreditSights nor its affiliates makes any representation or warranty as to the accuracy or completeness of any information contained in this podcast. CreditSights is not providing investment, legal, accounting, or tax advice, is not providing research or making any recommendations, nor is CreditSights offering or soliciting any transaction with respect to the purchase or sale of any security.